$4,550. Not a breakout, not a collapse, just holding. And sometimes in markets, holding at a level like that tells you more than any headline move ever could, because while gold is sitting there, something underneath it has already shifted, and most people are still looking at the wrong number. Last week I told you to watch one thing: the behavior of the US 10-year yield as it pushed toward that 4.4% level, specifically whether it would hold there or start to roll over under pressure from geopolitical developments. And what we saw over the last few sessions is that yield pull back to around 4.33% as new information hit the market, which matters more than it looks at first glance because it directly feeds into how gold is being priced right now. My name is John. I spent 15 years working inside currency and commodity markets before I started making these videos, and I have sat in the rooms where macro decisions like this get translated into trades, and I have watched what happens when retail investors are given headlines instead of context, and that is why I am here. Everything I show you today comes from publicly available sources, and I will name every one as we go so you know exactly where it is coming from, because today we are going to walk through three things that actually matter: what this $4,550 level is really telling you, why the move in yields is more important than the move in price, and how to think about gold here without getting pulled into either extreme narrative. If this kind of calm, data-first breakdown is what you have been looking for, hit the like button right now. It tells me to keep making these, and if you are not subscribed yet, now is the time, because what we are covering today is part of a bigger picture we are building week by week. Right now, gold is sitting around $4,550, give or take a few dollars depending on the session, and if you have been holding gold through this move from below $4,000 earlier in the cycle, you know how significant that shift has been. But what the price action is telling us right now is not momentum, it is stability, under pressure. And that pressure is coming from the bond market. When I pulled up the latest Treasury data and matched it with recent market moves, here is what stood out. The US 10-year yield pushed up to around 4.4%, which is an 8-month high, and then pulled back to roughly 4.33% as the market started pricing in a potential geopolitical de-escalation tied to a 15-point peace proposal coming out of US political channels. Now here is the key point: gold did not drop when that yield initially rose, and it did not spike aggressively when the yield fell. It held, and that tells you something about the underlying demand. Quick question before we go further: are you actively adding to gold at these levels, or are you waiting for a pullback? Drop that in the comments, because this is exactly the kind of moment where positioning decisions matter. Now let's unpack what most people are saying, which is that gold is simply reacting to yields, and that is true at a surface level, but it misses the deeper dynamic. Gold is not just reacting to yields, it is reacting to real yields, inflation expectations, and confidence in the broader monetary system. And this is where the stagflation narrative comes in. When I looked at the latest inflation signals and energy pricing trends, particularly oil holding above $100, what becomes clear is that input costs are not easing in a way that would give central banks a clean path forward. Think of it like a household budget where your income is fixed but your expenses keep rising at some point. You are not optimizing anymore. You are choosing which problem to tolerate. That is where central banks are right now. They can fight inflation by keeping rates high, which pushes yields up and pressures gold in the short term. Or they can ease financial conditions to manage debt servicing costs, which supports gold over time, but doing both perfectly is not an option. Now here is the data point that caught my attention: the yield pulling back from 4.4% to 4.33% might sound small, but in bond market terms, that is a meaningful move, and it happened quickly after the geopolitical headlines hit. That tells you the market is sensitive to any signal that could reduce risk. But here is where I want to stop and show you something that actually supports the cautious view, because this is where discipline matters. If those peace talks fail, or if the market starts to question their credibility, yields can move back up just as quickly, potentially toward that 4.5% level. And when that happens, gold can face pressure. Not because the long-term story disappears, but because the opportunity cost of holding a non-yielding asset increases. Think of it like choosing between holding cash in a high-interest account versus holding something that pays nothing but might appreciate when rates rise. That decision changes. If you know someone trying to make sense of gold right now, share this video with them, because this is exactly where most people get caught between narratives. Now let's come back to the structure of this move, because the phrase gold reset is not about price exploding higher tomorrow. It is about normalization. Gold trading above $4,000 is no longer shocking. It is becoming accepted, and that changes behavior. When I looked at historical price regimes and compared them to current conditions, what stood out is that markets tend to consolidate after large structural moves, not collapse immediately. Think of it like moving into a new house. The move itself is disruptive, but once you are in, you spend time adjusting, not moving again the next day. That is what gold looks like here. The $4,550 level is not just a number. It is a base being tested, and if it holds under different macro conditions, rising yields, falling yields, geopolitical shifts, it becomes more meaningful over time. Now, if you have stayed with me this far, this is where the macro layer really matters, because when I pulled up the latest World Gold Council data, central bank buying has remained structurally strong over the past few years. These are not traders reacting to headlines. These are long-term allocations, and on the fiscal side, when you look at us Treasury projections and debt servicing costs at current yield levels, the math is getting tighter. I am not saying there is a crisis tomorrow. What I am saying is that sustaining high yields becomes increasingly difficult when debt levels are elevated. For UK viewers, this dynamic is just as relevant. The Bank of England faces similar constraints, balancing inflation with growth while managing a debt-heavy system, and the LBMA continues to act as a central hub for global gold flows, meaning price stability at these levels is not just a US story, it is a global one. De-dollarization is a decade-long process. It is not a Tuesday event, but the direction of travel is visible in the data. Now layer in industrial and real-world demand dynamics. While gold is not consumed like silver, its role as a financial asset means it is deeply tied to confidence in currencies and systems. It is not burned, it is held, and when confidence shifts even slightly, allocation decisions change. Alright, let me show you how I am actually thinking about this week using the 3 lanes framework. This is how I separate what is noise from what actually matters. The paper lane futures positioning and bond market interaction is currently being driven by yield movements, with the 10-year Treasury pulling back from 4.4% to 4.33%, as reflected in recent Treasury data. The physical lane central bank buying and long-term holding remains stable, with continued accumulation trends noted by the World Gold Council. The macro lane geopolitics, inflation, and fiscal pressure is mixed but leaning toward structural support due to ongoing inflation and debt dynamics. In 15 years watching currency and commodity markets, the times I have seen all 3 lanes align in the same direction even briefly have historically been some of the most significant moments in these markets. I am not saying we are there today. I am saying it is worth knowing what to watch for. When the paper lane stabilizes, the physical lane remains strong and macro pressure builds slowly. The historical pattern has often been sustained support for gold prices, but that is a framework, not a forecast. You decide what to do with it. Here is the one thing I am personally watching this week. One thing, I will tell you exactly what I am looking for and exactly why, and next video the first thing we do is come back to this. I am watching whether the US 10-year yield holds below 4.35% over the next set of trading sessions, using Treasury Market Data as the source. If it stays below that level, it suggests easing pressure on gold and supports the idea that this consolidation is stable. If it moves back above 4.4%, it tells you the pressure is returning and gold may need to retest lower levels before finding support. This is my one call for the week, John FX Insider. On record, I will be back next video to tell you exactly what happened. No edits, no excuses. That is the only way this works. Now here is where I want to be completely straight with you, because this is where most channels pick a side and run with it. I am not doing that today. For the more optimistic picture to develop, you need to see yields remain contained, geopolitical risks stay elevated enough to support demand, and gold continue holding above this $4,550 zone. The combination supports a continuation pattern. On the other hand, if yields push higher, peace developments reduce risk premiums, and gold fails to hold this level, then a retest toward the $4,400 area becomes a reasonable outcome without breaking the larger trend. Both are genuinely possible right now. Your job is not to pick one and emotionally commit to it. Your job is to watch which conditions are actually developing in real time. The market will tell you, you just have to be watching. Before we close, the disclaimer you need to hear, and I mean it. Everything in this video is educational content based on publicly available information. Currency Insider does not provide financial advice, investment advice, tax advice, or legal advice. Nothing here should be construed as a recommendation to buy, sell, or hold any asset. Past market behavior is not a guarantee of future results. Always consult a qualified financial professional before making investment decisions. Before the 2 questions, if you got value from this today, the like button takes 1 second and it genuinely helps this channel reach people who are trying to navigate these markets without all the noise. Hit it now. I want to ask you 2 things. And I genuinely want your answers, not just a thumbs up. First, are you treating gold as a short-term trade right now or a long-term hedge in your portfolio? Second, based on what we walked through today, do you think yields are more likely to stay contained or push higher from here? Drop both answers below. The comment section here becomes a real-time sentiment tracker and I read every single one. Subscribe because next week we are going into real yield mechanics in detail and I will show you exactly how to read them. That is a skill worth having. And if someone in your life is watching gold right now and feeling unsure about what is happening, share this with them. That is the whole point of this channel. This is Currency Insider. Know the market, protect your currency.